Good morning, everyone, and thank you for joining us for our first quarter Global Fund Manager Workshop. I'm Mohini Naidu, Investment Analyst at Nedgroup Investments, and today we are joined by Brian Selmo of FPA, Co-Portfolio Manager of the Nedgroup Investments Global Flexible Fund. Brian joined the firm in 2008 and serves as Portfolio Manager and Head of Research of the Contrarian Value Strategy. Brian will be talking to us today about how the fund has fared and some of the drivers of performance over the past 3 months and 1 year. He will also share some insights into where the team is finding value today and how they have positioned the fund to avoid a permanent impairment of capital if there are further market downturns, while still participating in market upside to deliver on the fund's growth objectives through a full market cycle. Brian, welcome, and over to you.
Thanks, Mohini. And thank you for having me today for the first quarter fund update. We can move on to the next slide and we'll briefly talk about the sort of objective and mandate of the fund. As Mohini mentioned, it's for equity-like returns while avoiding permanent impairments of capital. And we do this over a global mandate where we invest in equities across the globe and then also invest in high yield and distressed debt, really primarily in the US market. Let's go on to the next slide. So we've titled this the beginning of the end, and I'm really getting at the end of the pandemic. There's obviously been a lot of hope and success with vaccines, and I think that we're hopeful, and certainly you can see markets are hopeful that the pandemic is going to be in the rearview mirror and that global economies will come out of it with quite a bit of strength, and there'll be an opportunity for sort of attractive investment opportunities on the back of that. But we never know. Whether it's the end, whether it's the beginning of the end, or really how the economy will perform on the back end of it. So with that as an overview, let's move forward on the slide. So looking at our portfolio, we're positioned about 70% in equities, and as you can see, very little in bonds. The cash position is sort of static, a little bit down over the course of the last year, and I think there's a few things we're thinking about here. One is the relative attractiveness of equities compared to other alternatives. So when we think about yields, they're incredibly low. And then two, wanting to invest in a diversified manner across a number of different names to provide ourselves a, defensive characteristic over and through market cycles or through the uncertainty that might come. Next slide. So here you can see where the portfolio is allocated. This is on a domicile of country in terms of where the companies are. And I wouldn't say that we spend too much time thinking about where the companies are domiciled. If we now go on to the next slide. We really spend a lot more time thinking about where the economic center of gravity is for our portfolio and for our companies. And there you can see, we're even more international in nature. Now, we have increased exposure to companies domiciled outside of the US in a meaningful way over the last couple of years. And that's really in response to valuation and opportunity, where we've seen cheaper valuations and maybe a greater discount to intrinsic value in some names that happen to trade in markets outside the US. But what's really probably most relevant when you think about the performance or economics of the business over time is where the revenue is generated. And there you see that the portfolio is really pretty fully diversified around the world, getting a pretty blanket coverage of where, I'll say economic activity is in the world today. Next slide. So in the last quarter, we've added a number of names that I think I would broadly describe as more defensive in terms of their underlying businesses, sort of consumer staple type or software companies. We've reduced some positions in financials as those have performed well and traded valuations that are less interesting to us at this point. I'd also point out that Willis Towers Watson is scheduled to be acquired by Aon, which is internationally domiciled. So really 3 of the 4 new positions are international in nature in terms of domicile. Moving on. So here's the performance over the 3 months, 6 months, 1 year, 3 years, and 5 years. And certainly the last year really reflects a period of somewhat off the bottom of the financial or of the global pandemic. And that's given a springboard to really, indexes, markets, as well as our portfolio. Certainly a year ago, our performance looked much worse, but that's kind of the nature of investing in a largely equity portfolio, is that there are going to be times when, markets are very unfavorable. And if your underlying research is, solid and the businesses are strong, you would expect to come through that and, kind of revert to some sort of normal valuation or market outlook. So today the world has a very different outlook than it did a year ago. Today people are very optimistic, whereas a year ago people were very pessimistic and really scared, and probably scared for good reason, because there was a great health unknown at that time. Moving on to the next slide. So here you can see the contributors by name. And, I think we would tend to focus on the trailing 12 months as being the more, relevant time period to look at. And, off of that time period, there's really been broad, strong performance across the portfolio. And really a lot of our larger names have been the key drivers of results over that time. There really isn't much to report in terms of losses. Many of those are names that were either exited last year entirely or very recently purchased, which you can see with just the takeaway in Alteryx in the first quarter. And so it's really no material losses over the last 12 months. Next slide. So this is just a quick overview of interest rates. And, this kind of ties back to the headline, the beginning of the end. It may be the beginning of the end of the pandemic, very hopefully, I would say, for us and probably everyone on the call. But it may also be the beginning of the end of super ultra low interest rates. And that could have very different impacts on financial assets. Of course, we don't know, but we do observe that it's I think probably a large risk for the developed economies, is that interest rates have been very, very low for a long period of time. And that's probably become embedded in a lot of companies' capital structures as well as government fundings. And if something were to disrupt that, there could be some negative tag-on effects. Next slide. This is just to remind everyone, this would be kind of what I would call the dog that didn't bark last year. So credit and spreads in high yield, there really hasn't been much opportunity here. You can see that current spreads are pretty low, as well as absolute yields are pretty low. And so this chart helps account for, why we have so little going on in credit right now. Next, please. So I guess this would sort of highlight some of the ideas or topics that we're thinking about, or things that are going through the portfolio. One, we do have the end of the pandemic, which is terrific. Maybe we have the, end of some of the sort of most speculative aspects of the market, and sort of the infatuation with, hyper growth type businesses. But maybe not. Maybe it's the end of super low interest rates, but again, maybe not. I think for us, we want to continuously improve the business quality of the companies we own and what the portfolio looks like. And then I think international versus US, I would say it maybe is something that we're agnostic about, but it's something that you've seen start to show up in the portfolio as a sort of a gradual shift over the last number of years. And that is continuing in the most recent quarter. But again, we're doing that on a bottoms up opportunistic basis. And that's my summary of the first quarter and a brief overview of some of the themes going on in the fund.
Thanks, Brian, for those useful insights. Can you talk to us about some of the top positions you have in the fund today?
Yeah, I'd be happy to. So if we look at this slide with our top 10 holdings, you can see a number of names, if you're familiar with the fund, that have been here if we would have looked a year ago, and some new names that were bought or added to opportunistically during the sell-off. So as many would know, we have an average 5-year holding period in our fund. So many of the names will still, be in different sizes, but will be in the portfolio over a long period of time. And starting with something like Alphabet, which we originally bought over a decade ago and have continued to hold on the back of the strength of the company's underlying business. Comcast is a business with a very strong position in the United States in broadband and video. And Comcast is a position that we added to materially during the sell-off last year. Things like Lafarge and AIG are more cyclical in nature and traded down to some extremely cheap valuations, which allowed us to increase their size as well through the pandemic and during parts of last year. If we move through the rest of the names, many of them benefit from strong secular trends and would exhibit the characteristics of high-quality franchise businesses, such as high returns on invested capital, strong free cash flow generation, and appropriate shareholder-friendly deployment of excess cash. We're also happy to be in companies such as GBL, Groupe Bruxelles Lambert, where there is an owner-operator or a long-term shareholder or family in control of the capital allocation decisions. That type of setup is something that you'll see throughout our portfolio and is something that we think matters a great deal when you end up holding businesses over longer periods of time, such as we do in the contrarian portfolio.
You're very close to a 70% risk exposure in the portfolio at the moment. We saw from one of your earlier slides that you've been a lot more active in the portfolio over the last year than you have been in many of the previous years. Is there a scenario where you could see yourself being even more invested in risk assets, like 80 or even 90%, similar to how you were around 2007, 2008, I think it was?
Yeah, this is always the difficult question of opportunity versus valuation versus cash, which is really a down payment on future opportunities. And so we never know what the market is going to do. We certainly wouldn't have over a year ago expected, for stocks to be down 40 or 50%, or in some cases even more over a 2 or 3 week period last March. And so when valuations get somewhat more stretched, we will tend to build up a cash position, not because we necessarily aspire to own cash over time. We don't. We would really aspire to be more invested, but because we think the risk reward starts to change in the individual names that we own or in the opportunity set that's available to us. So it's a balancing act, certainly. I think over the last year, you would notice that the portfolio was more invested over times. We've started to sell some things down in the first quarter this year, but we were in the mid to high 70s invested, and primarily in equities last year. As we've talked about before, the credit opportunity wasn't there to the same degree. I think one of the scenarios that we've always envisioned where we would be much more invested in risk assets is one where you had an opportunity in both credit and in equities. And there was an expectation, which turned out to be wrong early in the pandemic last year, that the credit side of the portfolio would expand dramatically. Now that didn't come to pass, probably because of a lot of actions that the Fed took to normalize the bond market in the United States and efforts that other governments took to sort of step in and fill the gap that might have developed on the credit side had a more traditional cycle taken place. I think the other thing that we would notice or observe and attention in terms of holding cash is that over time, currencies depreciate and currencies are not a terrific asset to hold. So I think we want to opportunistically increase exposures when we find good opportunities and opportunistically decrease exposures when we think that the opportunity set is less rich. Now, overall, I think we would aspire to average a higher exposure to risk assets, particularly equities, over time.
Thanks. And with cash yielding, up until a few months ago, negative real rates, still maintaining a sort of 25 to 30% exposure, are there any areas you're considering to potentially give you a little bit more of a positive return in the portfolio?
We are, and we're working on some things specifically on the cash portfolio where we may be able to do better than sort of the short-term either treasuries or commercial paper that we tend to purchase. And so we're working on that. We look at that actively, but primarily and as a first principle, we don't want to take risk with that part of the portfolio. So we want to make sure that that is both defensive and provides us adequate resources to play offense in the event or when markets sell off. Because while things are very positive today and everything seems wonderful in terms of outlook, we do know that there will be significant market opportunities and sell-offs at future points. The other thing I would say is, there's a pretty favorable and rosy outlook today in the world, but there's plenty of things that also one can worry about. And I think that the, potentially disruptive issues are largely around interest rates and probably inflation in the West as well. And so we don't know how those things will play out or if or when they'll be disruptive, but we do know that when everyone has a view or a perspective that there's going to be smooth sailings, it's often a good time to take some measures to add some defensiveness to a portfolio or to prepare for those times when things aren't quite so good, or when whether it's a pandemic or whether it's economic excess or whether it's just an industry or sector going through some difficulty. I think we're pretty confident that that will recur. I encourage everyone to think about how differently they felt a year ago when they probably wished that the portfolio had less invested in risk assets and wasn't buying, a lot of the positions that we were. And so, it's a bit of a tug of war, right, between opportunistically buying things and having a portfolio that can, earn positive and attractive absolute returns, while also avoiding sort of the permanent impairments. And I think when we talk about permanent impairments, we're really thinking about a few things. One is if you are in a business that loses its competitive relevance, or it's no longer able to sort of generate the kind of cash or earnings power that one had been expecting, that's certainly a way that you could permanently impair your position. But you can also permanently impair your position if you just pay too much for a good asset, right? At some price, any asset is going to produce an unattractive return, no matter how attractive that asset is. And so I think that those two things are things that we want to minimize in the portfolio, and we do that both on an individual basis, company specific, but also on a portfolio level basis, and cash can be very helpful on a portfolio level.
Thanks very much, Brian. One of the statements the Contrarian Value team makes in describing your philosophy is that you look at what can go wrong. So sitting here today with markets having run really hard, up 50, 60%, what is it that you're thinking could go wrong from this point on? What are some of the scenarios you're considering?
Yeah, I want to answer this with some humility, because a year and a half ago I wouldn't have said pandemic. So I think we all probably know how incapable we are to project or know the future. But I think that there are things ranging from geopolitical conflicts or tensions in different parts of the world to more directly economic issues, which we talked about a little bit earlier, and those being largely around rates and inflation. I mean, I think the developed world, Europe and the US, have really feasted on very, very low rates for a long period of time. And if that were to reverse, it would probably change some behavior. It would probably also have an impact on economic behavior. But that doesn't mean that it will change. Low rates could continue for a very long period of time too. And I think that those are really twin tensions, right? If you're a saver and rates are at 1% or maybe even 2%, but if they stay there for the rest of your life or for the saving period that you have in mind, that's a real big risk. On the other hand, if you have nothing but exposure to very high multiple assets, well, then any kind of change in those rates, if they were to go up, that's probably a very big risk to how you're positioned. And so I think that there's not one answer, I think, but you want to have a diversified approach of productive assets that you think can compound their intrinsic value over time, and that should set you up to do reasonably well, whatever might come from sort of the macro issues or shocks. And I think that we want to, on a portfolio basis, have well-financed, strong companies, and then when we think that there's a little bit less favorable of a setup, allow the cash position to build slightly, and then of course draw it down to try to be more invested over time.
On that note, thank you very much, Brian. We really appreciate your time today and for sharing your thoughts, yours and the team's thoughts, what you're thinking about in positioning the portfolio to be resilient to market downturns and to be able to capitalize on further market upside from here. And it really is very pleasing to see how performance has come back so strongly in the last 6 months. I don't want to jinx it, but thank you very much for yours and the team's hard work on delivering on this mandate. And thank you also to our investors from around the world who have joined us today. Thank you for your time. Thank you for your support. Stay safe, stay healthy, and stay invested.